Hello and welcome to Market Matters presented by MyX. I'm Joe Teague. With me, as always, is Brian Stutland. How's it going, Brian?
Great. Just bearing this deep freeze we got going on here in the Midwest.
Yeah, well, we got a jam-packed show today. It's going to be really good. We're going to be talking about the Fed and the Fed Watch and interest rates for 2024. We're going to be talking about Tesla. We're going to be looking at that later today. We're going to recapping our trade from last week, and we got a big options 101 you don't want to miss. But first, we're going to be talking about volatility and what it means for the market. So let's jump right into the weekly update. We got a lot of Fed speak this week, Brian. This is not too unusual, but I think the market will be paying a lot of attention to this. We got Fed basically every day and a big beige book too on top of all that.
Yeah, they should really give us some expectations about where they're heading for interest rates. So I'd be listening in and tuning in almost every day. If you look at all those Fed names coming across the board, do a Google search, whatever you need to do, listen to what they got to say.
We got earnings, of course. We always flip through on this. More banks coming in. Brian, do you see anything of huge import here on these earnings?
Yeah, I don't think any of these earnings coming up will be huge market movers. Goldman Sachs obviously reported today already. Next week is going to be the real big week, and we're going to get into a trade like that. Tesla coming up next Wednesday. So that's going to be a big market mover, and we'll dissect that and give you a trade coming up. So that should be an interesting one.
It will continue to set the tone. A lot more banks, a lot more financials going here.
Yeah.
We'll wait and see how it plays out. The investor sentiment we love to look at. Remember, the end of December, we really peaked out on the 52-week high. The market was pretty close to a high then too. So was it a sign? We'll have to wait and see. Also, Brian, I'm bringing up the CNN Fear and Greed Index now.
Yeah, I love looking at this index here because it actually is a combination of a bunch of momentum indicators, breadth of the market, where it's going. We're not quite in the overbought conditions, as you can see here, but certainly, we're on the higher end of the market, moving significantly over the last few weeks to the upside. And maybe we are a little overbought. It's kind of an interesting thing that I like to sort of check in on because it can give some oversold or overbought conditions. If, Joe, you bring up a little chart here, you can see this area towards the top end of it. We are near that overbought sort of conditions. We saw that earlier a few months ago, and then what happened? The market sold off, right? So this is something to sort of watch, and I think this kind of leads in, Joe, about our show here today. I mean, are you nervous about what's going on, or you think this market's got more legs to the upside?
Yeah, I mean, let's take it to the big story. Essentially, we're kind of at a pivotal point for the market. Yes, we got a lot of Fed speak this week. We got the January statement coming up soon. And I think the market's really going to have to adjust. Now, remember, we talked about this for a while. This has not moved much. This is the market's expectations here, Brian, for the last rate cut December, the December rate hike for 2024. The market says we're going to be at 375 to 400 basis points. We're currently 525 to 550. So we're looking at six or seven cuts based on these expectations. So that's pretty lofty. The market's asking the Fed for a lot.
Yeah, I mean, the dot plot is much different, right? I mean, if we bring up the next slide here, let's just kind of dissect that, Joe. I mean, the market's way overdone on rate cuts, right? I mean, we had a Fed governor speak today. What did he have to say?
And, the Fed actually did a good job at setting the expectations. When the Fed said they were going to hike, they hiked. When they said they were going to pause, they paused. So I think the Fed is going to set the expectations and get in line with the market. Remember, last July, the market readjusted to what the Fed was saying, higher for longer. We saw the 10-year move all the way up to 5%. And on that point, with all the Fed speak coming out this week, here's some Fed speak from Waller, just essentially saying concerns about the sustainability of this inflation. Is it going to stay down at 2%? Are we going to get to 2%? Maybe we shouldn't rush into things, essentially.
Yeah, I mean, I think he's basically saying we need to recalibrate somewhere between where the market thinks rates are going to get cut to and what the Fed dot plot is saying. And I think if you read this quote, just dissect it a little bit, take a moment to look in and read what he's saying. To me, I interpret it as, hey, we need to actually see 2% year over year inflation before we start to cut. right? We're getting there. We're not going to raise anymore because we've maybe raised enough to sort of get inflation down. But I don't think we're quite at that target yet. And so there's going to be some sort of middle ground, I think, meeting here. This actually might, I mean, if more Fed governors come out this week with the similar tone to this, I think it kind of freaks the market out a little bit, don't you think?
Yeah, and with that in mind, Brian, we got the beige book too. We got all the Fed speak that we brought up earlier. Last week there was some rumblings, there was some indications. If you looked at the volatility space, there was a little bit of a sign saying, hey, be warned, be worried out there.
Yeah, this is a chart here. It's called the VVIX, like we like to say. It actually measures the price of premium of options on VIX traded options, right? And we saw back in October, the VVIX really plummet. So what did that mean? VIX option prices declined relative to their historical being. And once that happened, that sort of vol suck that we like to call on the trading floor allowed the market to race to the upside. But now, last week, we saw a huge purchase of the February 17 calls in the VIX. 250,000 calls were bought. And look at this VVIX. It's spiked back up. So is this sort of a warning sign, maybe, Joe, that now we're getting into a period where vol is going to rise and a market sell-off is coming?
Yeah, it certainly seems like a warning sign. It certainly seems like we got all the Fed speak, but there's also just the natural seasonality of the VIX. And this is a really interesting chart here. This is just the VIX seasonally affected. Like we know the VIX is naturally low in December and January. We always knew February is a time when volatility picks up, but the VIX index actually, this is over the last 20 years, really peaks out in March here. So we're looking at, now that we're through Christmas and we're through New Year's Day and now MLK Day, this is right when volatility starts to pick up for the year. This is right when the rubber meets the road. February, really critical month for the year in terms of if it's going to be a positive or a negative one. And we should expect volatility to pick up. And volatility happens to be rather low right now. So it stands to reason that volatility will be increasing in the short term.
Yeah, well, I mean, if you don't believe in the seasonality trade and that patterns will mimic each other and who knows what's going to happen, if we take a look at the VIX chart here and we look, or the spikes index, which measures volatility on SPY, compared to SPY itself, the spider ETF on the S&P 500, we're seeing S&P 500 making new highs, right? But the spikes index making new higher lows, right? So both those are sort of trending in the same upward trajectory together. We want to see those things move opposite to each other. That's a normalized market. So when we see these things start to move together,
if you want volatility to go higher, you want it to go this way.
Yeah, right. If you're a volatility buyer, for sure, a hedger, as we are in our funds, right? We had a fantastic year in one of our strategies, the NASDAQ 100 hedge equity strategy that we trade, where we buy NASDAQ 100 stocks and we use a hedge with that. And we think right now it's poised to continue to do very well in this scenario. We want to own volatility here because look at this trend. If we break sort of this neckline on the spikes, the volatility portion, the hedge portion of our strategy will start to pay off because we've really gotten a lot of consolidation here in the marketplace. We got this sort of wedge formation happening. This morning we saw a break below it. So we're watching really closely here. A spike's above 14. And I'm going to be a put buyer here on the market, or I'm going to own VIX futures or something in a sense to hedge myself.
Yeah, and that makes a lot of sense. And the other thing that's going on up there, remember, this is something we brought up last week. Money supply is getting sucked out of the market. We always talk about the interest rates. We always talk about how critical those are to the market. But the Fed's also affecting the money supply. This is really crucial to the amount of money it's in the system, the amount, and then how the economy is doing broadly. And we also brought this up last week. And the less money supply that out there, the worse this chart gets. But essentially, the market cap does go up when the money supply goes up, but we're on the higher end of the range of the market cap divided by the money supply.
Yeah. So I mean, you look at here, like the fundamentals are basically saying we need a revaluation in the market. Volatility index and volatility traders such as ourselves, which we've done pretty effectively over the last year, not to pat myself on the back or anything, but those types of traders out there are saying a market correction is coming. And, then the seasonality trade, of course, February into March, getting some volatility spikes. So, we could be into some tough, scary times. Maybe not, throughout the whole year because we have an election and We know what happens in mid-year cycle election years, but a lot of things near term feel like, hey, we need a little pullback and reprice things.
Yeah, I mean, the counterpoint is, yes, this can turn around. The Fed might say, hey, we will set the expectations of fewer cuts, but we'll stop our quantitative tightening, maybe do a little quantitative easing. That's always possible. Like you said, this is an election year. We should be prepared for any possible outcome. All right, let's move it into...
You're so much of an optimist all the time, so I'm a little bit more pessimistic right now.
It's certainly possible. I think maybe the inevitable is always there, that things will slow down, but maybe it can be stretched out by some Fed actions. We'll wait and see. I'm open to either scenario. All right.
Okay.
Looking at the trade ideas, we know the Magnificent Seven has carried the market the last year. It's up to 30% right now of the S&P 500. Their PEs are much higher than the rest of the S&P 500. Maybe that's another area of risk if we do see some of these names come down. But Brian, what do you see in Tesla?
Yeah, this chart's kind of interesting because we kind of had this sort of head and shoulders bottoming process where we kind of got higher lows now and this upswing. It looked like some momentum to the upside. I personally own Tesla. I bought it months ago to try and play to the upside, but I'm starting to get a little concerned here. When you look at this chart, that upswing is really starting to lose some momentum. We haven't been able to sort of break that neckline just yet. And Tesla earnings are next week, right, on Wednesday. So I'm going to do a few things maybe to protect my long stock position. And one thing I might look at is because that $200 level in the stock basically is the 50% retracement level from those October, December lows all the way up to the mid 2023 high, going back over a year here. So that 200 level, really a critical level here. And we may retest that heading into earnings. So here's a trade I'm going to do. I'm long stock, right? Earnings next week. I'm going to trade options that expire next Friday, right? So this is very short-term trade, looking to buy those January 220 puts for about $8.40. That's what they were worth when the stock was around 220.85. And I'm going to lower some of the cost of that trade by selling the January 200 put, that $2.10. So net debit is about $6.30 here. I'm basically risking $6.30 for a max profit of $13.70, which basically would, if I'm long stock, it essentially protects 2/3 of a downward move to that $200 level that I'm talking about. So I want to just get some protection in here in earnings in case there's a move to the downside.
Yeah, it seems like a good amount of protection. It does seem like potential volatility catalyst is there with the earnings, and this does not look pretty. I just got to be honest with you. We got some lower highs in here. It does seem like it wants to go back and test this neckline here, which hopefully it will hold, but there's no guarantee that it will.
Yeah, I mean, I'm not willing to give up on my stock yet, but I want some protection into this earnings play. And you look at the earnings over the last 4 quarters, the stock has moved 9 to 10% after earnings. So that's significant to me. These options seem pretty cheap if we get a 10% move in Tesla.
All right, let's move it on to the question of the day. We had a trade last week into earnings. And by the way, I think we're on fire, just en fuego on all of our calls that we've made. We did the JP Morgan earnings trade last week. Brian, walk me through your trade and how you handled it.
Yeah, well, as you remember, we sold this call. It was a weekly call that expired right after earnings. The stock did pop on Friday last week. So, I was a little nervous, but that was an entry level that I was willing to get short the market, short JP Morgan in this sense. And so I was okay having that call kind of be, put to me where the stock would be forcing me to short the stock. And it paid off. The stock backed off of those highs. We felt like when you looked at that trend channel that we would back off, that we were really on the top end of this trend channel. That's why, trading technicals, Joe, is really important in watching that to figure out what strikes you want to put in some option positions and how to hedge yourself. And now the stock is back in the 160s, 166, I think, trading earlier today. So this was a winner. I'm not sure I reinitiate anything here. I probably just had, hey, I took in that income. I let the trade off. We're still going to own the stock in our portfolio. as a whole is a small percentage. Financial is really not a big part of our portfolio, but this is a big money center bank. I think it kind of hangs in there, but certainly it was due for a pullback.
Yeah, maybe had a little bit of white knuckle action on Friday, but yeah, all's well that ends well. That's for sure.
All right. So every point in the show, Joe, we like to give everybody a trade idea. This is our segment, Options 101. Joe, you're talking about a straddle. What does that word mean? How does it trade, and what do you do?
Yeah. Well, let's look at the options trading strategy that stands out. It's one of the first when it comes to options trading. It's a straddle. Now, a straddle is a chess move that is a call and a put on the same strike. So this is playing both sides of the field, and that's why it's called a straddle. So what makes it so different is it's all about neutrality. Now, it's not about picking a direction. It's about picking the quantity or the amount of direction. So this is all about will it go up or down? It's all about the movement. So let's take a look into it here. So it is a long call strategy, which looks like this, and it is a long put strategy. And I sometimes, being a stay-at-home dad, you straddle snow days at home too. So long call, long put is a long straddle right here.
Yeah, there we go. So let me just take over here as the kids interrupt a little bit, but that's what happens, like you said, on snow days. The reverse of a long straddle would be short a straddle, where you sell a call and sell a put. In that case, you actually want the market to stay in the same spot, not expand away from the strike price. So this is a way to play both sides of the market. You either want the market to sit still in the case of a short straddle, right here, where you're combining both a short call and a short put, or the long straddle, you want the market to move away from that strike. So this is a way to sort of play volatility levels and where you think the market is going to sit still or move. All right, so that sort of wraps up our show. That wraps up our show for today. We've had a great show, a lot to digest about the market. Certainly, a lot of volatility, a lot of Fed speak this whole week. So tune into that, watch that. Hopefully we gave you some good insight. I'm a little nervous about things where they could shake out over the next, few weeks. My target still is higher in the market, but temporarily, I don't know. It looks a little sketchy from a fundamental and technical basis to me. We'll bring you more action next week. Today we went Tuesday because obviously Martin Luther King, markets were closed. Next week we're back on our normal schedule. Monday, tune in, 1 Eastern. Love the show. Joe, thank you very much for your commentary. Mayax, thank you for the sponsorship on the show. Tune into Tradier here on the HubSpot, and we'll see you next week.
Don't forget to send us your questions, comment, like, subscribe, all those things. Share it with all your friends. Tell the world.